This is John Martinka, and under the category, what is a small business worth? Let's go over some of the terminology because it can get rather confusing, trying to determine what really is the business making. 95% of small, medium-sized businesses are valued based on the profit they earn. The more profit, the more they're worth. Occasionally, a business is valued based on something else, but that's usually because in the eyes of the buyer, the business is worth more than the profits say it is. But for most of you out there, it comes down to what are you making? And profit is the word that is commonly used. What's the business's profit? Now that should be earnings before taxes. It should be earnings after all reasonable, customary, and legitimate expenses, including a fair market owner salary. But then things get convoluted because you throw in the term EBIT, E-B-I-T, where I is interest, earnings before interest and taxes. Then you have EBITDA, earnings before interest, taxes, depreciation, and amortization. And that can make things wildly different. Two businesses, both doing the same sales and the same EBITDA, could be valued tremendously different because one may be a manufacturing operation that spends hundreds of thousands a year on equipment, the other a service business that buys new computers every 3 years. So EBITDA can be a very confusing term, and if you really want some entertainment, Google Warren Buffett and the term EBITDA and see his choice responses on the use of that term. There's also one used a lot in small businesses when they are for sale, and it's called seller's discretionary earnings, which is salary and profit and perks added together under the assumption that all of that is discretionary to what the owner is going to do with it, whether they pay themselves salary or not. I don't like it, I never have, because it doesn't really give you true profit. A very well-used term is free cash flow. It's EBITDA less operating interest and anticipated capital expenditures so you can allow for buying new equipment, buying new vehicles, whatever the company has to buy. 5 different terms, can get confusing. Free cash flow, in my opinion, is the best, and most businesses are going to be valued based on a multiple of free cash flow or profit. Thank you. This is John Martinka.